In this video, I have the best trading strategies for you using the stochastic indicator, and I also show you how to find the best entries using this indicator. But first, I want to spend a few seconds showing you what the indicator does, how it is calculated, and how we can use it in the right context, because a lot of traders use it actually incorrectly and they don't have a full understanding of what it is. So I added it already to the charts. In TradingView, you just go to indicator and type in stochastic. All other trading platforms should have this indicator as well. It's a default indicator. What I did is when you open the settings, I deactivated the D line, which essentially is just a moving average on the stochastic. The heart of the indicator is the K line. This is what the indicator is, and this is actually what we call the stochastic. The D is just the moving average. Also, what is important to see is that the stochastic uses a 14-period default setting, which means that the stochastic looks back 14 candlesticks. In TradingView, we can just use the measurement tool just to see how far back are 14 candles. So 14 candles is from this point on. Let me just mark it, and then I'll show you why the indicator goes up and down and how it's calculated. And the indicator looks at a few different data points. It's very simple. So what the indicator does is for the last 14 periods, it looks at the low, which is here, the low of this candle. It looks at the high. And the last thing that it does, it looks at the current close. So this is the close of the current candlestick. And when we look at the range, you can see this is the height of the range. And what you see is that the close is fairly close to the absolute high of that range. And if that's the case, the indicator is showing you a very high value. And the stochastic indicator, therefore, is a speed or a momentum indicator. It basically shows you, for the last 14 candles, how strong is the market pushing up or down. So what we can do is go forward. Let's go forward maybe 2 or 3 candles to see what is happening. Let's see, one more candle. Okay, and now we can look at it again. 14 candles. We know where it is. It should be here. So this candle is 14 candles. The low after this candle is here. The high of this candle or of the 14 candles is here. And the close is nearly at the absolute high. And you can see when we go to the stochastic, you have a value of, when we go look at the right of the scale, 99.8, which basically means that the market closed 99.8% to the absolute high of this range. And this is essentially what the indicator is doing. In a downtrend, obviously, it works in the opposite way. So what we can do is, for example, look at this downtrend here. And let's start here. And what can we see is when we look back 14 candles from here. By the way, to measure the range in TradingView, you just hold Shift, you click, and then you get this measurement tool. So we look back 14 candles, and this is what we have. So the high of this 14 bar period is here. The low of this 14 bar period is here, and the close is here. And you can see we have a very low stochastic indicator at 8.08, which means that over this range here, the market is almost at the absolute low. So it is 92% closing to the absolute low, and we have 8% left from the close to the absolute low. And then let's just fast forward to see what is happening when the price changes a little bit, so I can show you a few different examples. So now it's interesting because now we hold Shift or click and then look back, okay, where's 14 candles? Here at this doji. Then the height of this range is here, the low of this range is here, and the close is here. So you can see now 13%, or the stochastic is 13, which means we are 13% all the way to the downside. So now we understand what the indicator is doing. It measures the trend strength. How strong is the market pushing into a given duration over the last 14 periods? So how can we use it to find trade entries? The first major problem and the first major mistake that many traders do is that they believe that when the stochastic is in so-called oversold, so traders would say that when the stochastic is here below the 20 area, they would call this oversold. When the price action is above 80, they would say the market is overbought. And many traders believe that this is a sign of exhaustion. They believe that when the market is, or when the stochastic indicator is below 20, it shows you that the market has a high tendency to reverse. However, as we have just learned, this is absolutely completely wrong. And what it means when the stochastic is below 20, it means that the market is just very strongly pushing downwards. When the stochastic is above 80, it means the market is strongly pushing upwards. So the last thing that you want to do is fight your stochastic. You want to go with the stochastic. When the stochastic is below 20, you are in a very, very strong trending market. One thing that you could do is in the stochastic, go to style and highlight the middle band. Make it a little bit thicker, make it really stand out. And you could use this as your tiebreaker to determine, are you in a bullish or in a bearish market? When the price or when the stochastic is below 50, you are generally in a downtrending market because the market is now pushing more into the downside of the range rather than in the upside of the trend. So this could be a very great trend filter to have on your charts. And you can see it during trending markets. The stochastic will generally stay below 50 and also very often dip into the 20 area, which then indicates an even stronger trending push. Another way how we can use the stochastic is using it as a divergence indicator. Most of the momentum indicators, such as the RSI, the stochastic or the MACD, can be very effectively used for finding divergences. A divergence, as I explained in my last YouTube video, is a situation where the indicator and the price action are not agreeing and they're showing separate signals or different signals and opposing signals. For example, here we see that the price action is showing you higher highs, but when we look at the highs of the indicator, we see that the indicator is making lower highs. This indicates that although the price action shows you a bullish trend, the indicator is giving you warning signs that the trend is actually not that strong and you have more bearishness in the market actually. And why is this so in case of the stochastic? It is because the market is not able to close at the high. Here you can see during this bullish trend, the market was easily able to close at the highest points, whereas here the market fails to close at the high point and we see that the market keeps pulling into the lower end of the price action. So that's a very, very strong indication that the powers are shifting. Then we roll over. What we have just learned is that during the downtrend, for the most part, the stochastic will stay below 50. Just occasionally here, one time, very briefly, we dipped above the stochastic 50 line during this pullback, which happened here. You can see price action-wise, that's not a very threatening signal. So you can see price action is always leading. The indicator is just giving us other confirmation. And you could have used it as a pullback criteria. And also, as long as the stochastic is staying below 50, you can trade this down with a lot of confidence. Now this seems to be changing, and when we look at the market, what we see here is that also we have a major divergence on the price action. When I move this out of the way, so here you can see I looked at all the lows of the stochastic here, and you can see all of the lows are going higher, whereas on the price action we are still in a downtrend. As we have learned, when the stochastic moves up, it shows you that the market is not able to push lower as much. And you can see that the absolute low of this area here is here, and the price is not able to close at the absolute low, whereas previously the market generally was able to close at the low or very, very close. We have only very small wicks pointing downwards that are sticking out. This is why the indicator is here very low, because the market is pushing into the lows. Here the indicator is showing us that the market is not able to close at the lows, and we have those wicks confirming it further. Then we could also use maybe a pattern. We could trade with a regular breakout approach. And if the market breaks out above this and stays above 50, you would then say generally you are in a bullish trend and you look for bullish continuations. Let's see what TradingView does. You can see very strong rejection here, very strong momentum candle. And on the breakout with the stochastic staying above 50, you would generally consider this an uptrending market. And then you can see when we fast forward a little bit, this was the initial trend push. Then you can see the market dip below the 50 stochastic. Here as well, you had a lot of early warning signs that the strength of the bullishness is fading here. The market is not as strong as it was during this uptrending market. Whenever you see prolonged periods below the stochastic, that should be a big warning sign. And you can use that if, for example, you've been long here to get out of your trade for a good reward to risk ratio. In this case, you're not giving back a lot of profits because you're still trading very close to the high point. So the pullbacks, although they reach below 50 here on the stochastic, were not very deep, and the indicator picks up those little nuances in price action and really helps us understand the momentum on a deep level. How I really like to use the stochastic is as a higher time frame filter. So in TradingView, what we can do is actually open the settings, and then here under time frame, now we are on the 30-minute. What we could do is select a 2 hour, And then we get the stochastic from the higher time frame on this lower time frame price action chart. And so you can use the higher time frame trend filter right away without having to switch back and forth between the time frames. And what you can see is that the stochastic is well above 50 here for most of the time, and the market is moving higher. So this is another great way of using the stochastic as a trend filter tool. Then we roll over. Do we have a divergence? Not really. We have lower highs here. So the indicator is picking up here the loss of momentum. Although the market is still making higher highs, here then we have equal highs, double top. But the indicator, as we move into the double top, already shows us that we are seeing a lot of shifting in the strength. Then what we see is a dip below the 50 area on the stochastic, and we roll over into a bearish market. So now the market is bearish, the price action here is moving down, and the stochastic is below 50, bearish market. And then you can see we can use that going forward. Obviously, it doesn't always work all the time, but nothing in trading does. What we have to do as a trader, find periods where this works well enough so that we can realize large enough winning trades so that when it doesn't work, the winners can pay for our losses. And this is exactly what trend following is all about. We need to find big winning trades so that when trends emerge, we can really capitalize on them. And then when the market goes into sideways or when we have a lot of false signals, then our signals may not work as well and the losses are taken care of by the larger winning trades. But using the stochastic with this higher time frame approach can really have a big difference in your trading and can help you understand long-term trends and anticipate them in a very good way. Now let's take a look at a combination of using the stochastic with regular price action and trend analysis. And we're starting here with a base breakout. This is what we would call an accumulation pattern. Zooming out, the market was in a downtrend. Then we bottomed out here for an expanded period of time. Then you can see what we have is a so-called cup and handle. This is the cup, this is the handle. Then we have the breakout out of the long-term range. Here also we have a fake out pattern, which is very important. And now we could be at a starting point of a new uptrend. What I'm doing here is that we are on the 2-hour time frame and I'm using the 4-hour stochastic with the default settings. And one thing that we do is we look for bullish opportunities as long as the stochastic is above 50. Another thing that we could do is wait for the market to pull back right into the 50 level and then look for pullback opportunities also in the bullish trend direction. Another thing that is very common is to see V reversals at pullbacks. So what you often have is a jump below the 50 area of the stochastic and then an immediate reversal back above it. This is a very strong rejection signal during pullbacks. Another thing that is very helpful is to add the weekly pivot point. So this is the central weekly pivot point. And during a trending market, this is probably one of the best indicators that you can have. So now what we do is we wait for the market to trend and then pull back and see what we can do. If you are an early trend following trader, this would have been already your first bullish entry point. After the successful breakout, the stochastic on the higher time frame is well above 50. So let's see what we have. The market is pulling away. The moving average is up. Let's wait. If you are not in a trade yet, you would have to wait for your first pullback. Pullbacks generally happen around the 50 area or into the weekly pivot or into the moving average as well. This is a 50 SMA, by the way. So let's wait for the first pullback. So now you can see we have a strong pullback. The stochastic is below 50. And if the price action keeps going down and trading close to the lows, the stochastic will stay here below 50. In that case, we're not going to do anything. However, if we see a reversal back above the 50 area, this is where we then could look for re-entry opportunities, new long opportunities into the trend direction. Now you can see we're seeing signs of a bullish reversal. This could be a V bottom. Remember one of my last videos I talked about fake outs and I made a fake out video. And this is generally considered a fake out. Let's see. We need some more bullishness to get into a trade. And at that point, now it's clear that this is a fake out. We are in a bullish trend. We only have a brief dip below the stochastic. You can see we stayed below the 50 stochastic line for 1, 2, 3, 4, 5 candles, 4 or 5 candles. So that's not a lot. We are very strongly back above the 50 area. We are still in the bullish context here. So although the stochastic was briefly below 50, it doesn't change the price action, it doesn't change the trend direction. We have also here retested previous highs as support. So at that point, this could be a second bullish opportunity. The fake out is here really what makes the difference. The strong reaction and the strong rejection of the bearish selling attempt. So next bullish trend and trend entry could be here. We are here above the 80 level on the 4-hour stochastic, which is a very strong bullish signal. The new pivot point is now here, just underneath the recent highs here of the range. We could use this as a retest opportunity. So if you are not long yet, and if you haven't taken the breakout, this could be another entry opportunity. Break and retests often happen around very similar areas. So this could be your next entry opportunity. See, we're retesting the pivot. Great confluence. As long as the pivot holds, I would be super bullish, especially looking at the overall picture as well. You can see here we made the double bottom at the moving average, at the previous resistance, turning into support. Above the pivot, very strong bullish signal overall. The market keeps moving higher. So now everything looks good. Your first position, what I would recommend, move your stop loss right underneath the pivot point. And for the second and third breakout or re-entry opportunity, you probably would have your stop loss now at a very similar area, right around break even, which is a good place to be. So let's see what the market does. The new pivot point is now set to here. You can see because of the long sideways range, the stochastic briefly dipped here below 20 or 50 rather, sorry. No big problem as long as we get above the 50 area, which we do. You could now trail your stop loss from this pivot to the next pivot to lock in more profits. And now you can see we're retesting the pivot. We're moving away, which is a very good bullish signal. And we have a continuation. So you can see if you haven't been long yet, and if you've been looking for long entry opportunities, this could have been your next breakout opportunity here. Let me just speed it up. We're retesting previous resistance now as support. Very classic how this trend behaves. We are seeing everything that we need. Our stop loss has been locked in now along the pivot points. You could, as the trend progresses and as your reward to risk ratio increases, as more unrealized profits you have, the more aggressive you want to be in your trades. What you could then decide to do is to be a little bit more aggressive with your trade management, to either close out partials, so close maybe 25, 30, 50%, and then lock your stop loss along the moving average. Generally, a good rule of thumb is that as you have more profits, more unrealized profits, you want to be more aggressive with your trade and with your stop loss trailment, because now you can give back even more profits. The market is very far away from your entry, and if you don't manage your trade aggressively, the market could take back a lot, and that is not ideal, especially if you have already captured such a huge trend. So now let's see, we get a new pivot. As long as pivot holds, that's a very bullish signal. So we have a pullback. You can see we dip below 50, come back above it, dip briefly back below 50, but are very quickly above it. Very bullish signal. Let's see, do we get the continuation? A little bit. The market is not very strong right now. So we have to see the market is now pulling back, but not very strong. Very brief dips below the 50 level on the stochastic are very common. They're nothing to worry. What you don't want to see is an extended period of time below the indicator, while also the price action is showing you bearish signals. For now, even though we had periods below the 50 on the indicator, we have never had a bearish signal. The most bearish signal that I would think about is a break and a retest of the weekly pivot point to the downside. As long as the market is staying above the pivot points, that's a very bullish signal. If we would get below it, that would change the picture. But for now, you can see we have not had that. We are still in a very strong bullish market. Let me just fast forward a little bit. And now you can see this is what I was referring to. This is what changed the whole situation. Here is where we broke below the pivot point for the first time, and then we retested the pivot point now as resistance. Whereas previously the pivot point always held as support, here quick fake out, here support. Now the pivot point is resistance, and this would change everything for me. If I would still be in a long position, this is definitely an exit signal. And now you can also see the stochastic stayed below the 50 level for an extended period of time. So this is now showing you a very different picture. And we can very nicely combine everything. The pivot point, the trend analysis, the stochastic, and also the price action on our charts. So this is how you can get the best out of all the different concepts that you're using. Don't only rely on the indicator, don't only rely on price action, but try to put everything into context. Also trend trading, trend stages, trend maturity, and that's how you can really level up your price action and your trading.